Welcome to the Deep Dive, the show that gives you the knowledge you need without the information overload.
Today, we're tackling a monster of a topic in cross-border finance.
We really are. We're looking at how to manage U.S. 401k, Canadian RRSPs, and TFSAs, especially if you're a foreign national, a visa holder, or just someone moving between the two countries.
And this is an intensely complex area. I mean, our mission today is really to cut through the jargon and give you the specific warnings and, the insights you need to avoid some pretty crippling tax penalties.
And the scale of this is huge. Every year, over 200,000 people get a U.S. work visa.
That's right. And every single one of them faces this exact retirement planning dilemma.
So the immediate appeal of a U.S. 401k is, well, it's pretty seductive. You get tax-deferred contributions and often a really handsome employer match. But here is the immediate crucial warning, and this comes directly from cross-border financial planners. Before you contribute even a dollar, you have to understand the tax treaties.
Absolutely. You need to know how the country you plan to return to, be that Canada or India or anywhere else, is going to tax those 401k withdrawals down the road.
So that future plan dictates your entire strategy today.
It does. If you don't know the rules of your destination country, you could be setting yourself up for some serious double taxation.
Okay, let's unpack the U.S. side first, the 401k fundamentals. It's just such a powerful savings vehicle, especially with those high contribution limits.
It really is. I mean, the 401k is a tax-advantaged defined contribution plan. You have the traditional version, which uses pre-tax dollars.
So you defer the income tax until you withdraw.
Exactly. And then you have the Roth version, where you pay taxes up front, but then the growth and the qualified withdrawals are entirely tax-free.
And for 2025, the contribution limits are pretty generous.
Very. Employees can put in up to $23,500 annually. And there's a $7,500 catch-up for those 50 and older.
Plus the employer match.
Right. When you add that in, the total annual additions can get up to, $69,000. That's serious money growing tax-deferred.
What's fascinating to me is how foreign companies setting up in the U.S. have to navigate these heavy U.S. regulations just to offer this benefit.
Oh, they absolutely do. They have to comply with two massive regulatory structures. First, there's the Employee Retirement Income Security Act, or ERISA.
ERISA, so that's about protecting the funds.
That's it. It imposes strict fiduciary duties. That means they are legally obligated to protect the employee funds and manage them responsibly.
And the other side of that coin is the Internal Revenue Code.
Right, and that governs the tax treatment. To keep that tax advantage status, the plan has to pass these annual non-discrimination tests.
To make sure it's not just favoring the high earner.
Exactly. They have to make sure benefits don't disproportionately favor the highly compensated employees, or HCEs. It's a real administrative juggling act.
And these rules are always changing. Tell us about the Secure 2.0 twist.
Yeah, that act, which came in at the end of 2022, now requires mandatory auto-enrollment for new plans.
So you're in unless you opt out. You're in. They have to start employees at a certain contribution rate, say 3%, and then automatically increase that rate over time, often up to 10 or even 15%.
That must boost participation a lot.
Dramatically. Which is great for retirement savings, but it just means more complexity and monitoring for the company running the plan.
So the crucial question, who is actually eligible? Do you need to be a U.S. citizen?
Not at all. Eligibility hinges entirely on having W-2 U.S. source income.
So visa holders are in?
Yes. Foreign nationals on H-1B, L-1, or E visas are typically fully eligible as long as they meet the plan's minimum 10-year requirements.
Okay, let's move into the tax maze, because this is where the planning becomes absolutely critical. The IRS separates U.S. taxpayers into two main groups, right? Resident alien versus non-resident alien.
And that one distinction dictates everything. I mean, everything from the form you file to how your withdrawals are treated.
So if you're a resident alien and RA, you're taxed just like a U.S. citizen.
You are. You either have a green card or you have to satisfy the substantial presence test, the SPT. The SPT. This calculation is where people's eyes just glaze over.
Yeah.
We need to demystify this weighted formula without, causing mass listener math fatigue.
Right. Let's try. Think of the SPT as a weighted average that really prioritizes recent time spent in the U.S.
Okay.
You must be physically present in the U.S. for at least 31 days in the current calendar year. That's the first hurdle.
And the second part.
And you have to hit 183 days over a 3-year period, but those days are weighted. The key thing to remember is this. 100% of your days this year count, but days from 2 years ago only count for 1/6.
So your recent U.S. presence matters way more for your tax status.
Way more. And if you pass that test, you file the standard Form 1040. If you fail, you're a non-resident alien or NRA.
And NRAs file a different form.
That's right, the 1040NR or 1040NREZ. And the immediate disadvantage for most NRAs is you can't take the standard deduction.
Which means more of your income is subject to tax.
Typically, yes. Now, for the withdrawal tax trap, if you take an unqualified early withdrawal, so before age 59 and a half, the tax consequences shift wildly depending on your status at that moment.
At the time of withdrawal.
Okay.
If you're an REA, a resident alien, the withdrawal is just added to your annual income plus that universal 10% penalty.
Simple enough. But if you're an NRA...
If you wait until you're an NRA to withdraw, the income may be treated as effectively connected income, or ECI.
Okay, let's pause there. What exactly is ECI for our audience?
So ECI means the IRS treats that income as if it were directly connected to a business or trade you're running in the U.S.
So it's not just simple investment income?
No, it subjects it to the same graduated and potentially higher income tax rates that U.S. citizens pay. It's a much less favorable tax position.
But our sources pointed out a really surprising carve-out for NRAs. Something about the number $4,050.
Ah, yes. This is a fascinating nuance. If that 401k withdrawal is your only U.S. income for the entire year, you might be able to avoid federal income tax entirely by withdrawing $4,050 or less. And why that specific number?
It's tied to the old personal exemption amount. Now, is it a common strategy? No, not for people with substantial savings. But it's a really important loophole to know about if you just have a small legacy account left over.
So you could pull those funds out federally tax-free?
Potentially, yes. But the 10% penalty still applies. And you have to deal with the potential withholding shock.
Right. The plan administrator could just hold back a chunk of your money.
A big chunk. They might withhold up to 30% of the disbursement for NRAs right off the top.
Wow.
Now, this is often refundable when you file Form 1040NR, but it's a big hit to your immediate cash flow. And yes, that 10% early withdrawal penalty is the price of admission, RA or NRA. It doesn't matter.
So we've established this is highly inefficient. And yet, the sources suggest that for foreign nationals who know they're leaving the U.S., contributing to a 401k can still make financial sense.
It can, and it's all because of the employer match.
That's the trade-off.
Exactly. Let's use that example. You contribute $5,000, and you get a 100% employer match. You now have $10,000.
Instantly.
Right. And you got a tax deduction on your initial $5,000. So even if you withdraw the full 10 grand as an NRA, pay the income tax, and pay the 10% penalty, the total amount you get back can still easily be more than your original $5,000 out of pocket.
It's essentially free money, even with all the penalties.
It can be, yeah. The math can work out in your favor.
Okay, so that makes the math compelling. Once someone leaves their employer, what are the three main options for managing that money?
The first, and usually the least tax efficient, is just a lump sum withdrawal. Take the cash, accept the tax hit, accept the penalty.
But isn't paying a 10% penalty just a colossal waste of potential growth? Wouldn't keeping the money invested for even a few more years easily eclipse that initial match?
If you stay in the U.S., absolutely. But if you're a foreign national returning home, you might be motivated to just consolidate your funds and close out your U.S. tax filing requirements entirely.
So the lump sum becomes a pragmatic, if costly, final step.
It can be, yes.
Okay, what about option number 2, the rollover to an IRA? That's the rollover to an IRA. This lets you separate the money from your former employer's plan, which often unlocks more investment choices and even some additional penalty-free withdrawal exceptions, like for higher education.
But there's a catch.
There's a practical catch. Many IRA custodians won't service accounts for non-U.S. residents or people without a U.S. address, so you have to check that custodian's policy very carefully.
And the third strategy is for longer-term access to avoid that 10% penalty completely.
That's the periodic payments strategy using what's called the 72T exception. This allows you to take substantially equal periodic distributions based on IRS life expectancy tables, penalty-free.
What's the commitment there?
It's a big one. You have to continue these payments for 5 years or until you turn 59 and a half, whichever is longer. You cannot stop or change the payments without triggering all the penalties retroactively. It requires discipline.
Okay, now let's get to the true cross-border migration warning. A Canadian resident decides they want to move their U.S. 401k directly into a Canadian RRSP.
That is the single most common mistake people try to make. And the advice is very strong. Do not attempt a direct transfer without specialized consultation.
It's not like rolling a 401k to a U.S. IRA.
Not even close. It is rarely a tax-neutral event. You generally have to formally withdraw the funds in the U.S. first, pay the U.S. tax, and then deposit the net amount in Canada.
So what is the tax-efficient transfer strategy for Canadian residents? How do you do it right?
The key is using some special rules that let a lump sum withdrawal from a qualified U.S. plan be deposited into an RRSP or RRF without using up your precious Canadian contribution room.
And this only applies to certain plans.
Correct. The U.S. plan has to be a foreign pension plan, like a 401k or a foreign retirement arrangement, like a traditional IRA. And it must be a lump sum payment, not a series of periodic payments.
And here we have to talk about the Canada Revenue Agency's biggest warning, the GAAR risk.
The general anti-avoidance rule, this is a big one. If the CRA investigates and decides that a U.S. pension was rolled into an IRA primarily to get around the rules.
So you engineered the rollover just to facilitate the Canadian transfer.
Exactly. If they believe the entire purpose was solely for tax avoidance rather than for legitimate retirement planning flexibility, they can step in.
And what happens then?
They can disallow the tax-efficient transfer of the employer contribution portion, and that can lead to a massive tax bill in Canada.
Which is why you have to talk to a cross-border advisor before touching that money. Now, okay, let's jump over to the Canadian side now. Let's look at the RRSP and the TFSA for newcomers.
Right. So the RRSP, the Registered Retirement Savings Plan, it works a lot like a traditional 401k. Your contributions are tax deductible, and the growth is tax deferred.
And the TFSA.
The tax-free savings account uses after-tax dollars, but all the future growth and all your withdrawals are completely tax-free.
Now, the RRSP has an immediate hurdle for people who have just landed in Canada.
It does. Your RRSP contribution room is based on 18% of your Canadian earned income from the previous year. So if you just arrived, you have zero room in your first year.
But there's a vital clarification here for people with a new job.
A very important one. If your new employer enrolls you in a defined contribution pension plan, a DCPP, your mandatory contributions to that DCPP do not count as over-contributions in that first year.
So you don't get penalized?
No, they simply reduce the contribution limit that gets calculated for you the following year.
So if the RRSP is unavailable in year one, the TFSA becomes the critical planning tool from day one.
Absolutely. The TFSA is the huge advantage for newcomers because the contribution room is immediately available once you become a Canadian tax resident, as long as you have a valid SIN and you're over 18.
It doesn't require any prior earned income.
None at all.
But there is a penalty waiting if you jump the gun on that TFSA contribution.
Oh, yes. Do not contribute to a TFSA one day before you are officially a Canadian tax resident. If you do, that amount gets hit with a painful penalty of 1% per month for every month it stays in the account.
So you have to wait until you've established residency.
You must wait.
This often means the TFSA is just the smarter strategic choice for people starting out, especially if they're in a lower tax bracket.
Precisely. If you're starting out at a lower salary but you expect big salary jumps later, the TFSA is ideal because the withdrawals are tax-free and penalty-free. An RRSP withdrawal, on the other hand, is treated as taxable income.
Which could push you into a high tax bracket right when you need the money.
Exactly.
And for all immigrants bringing assets into Canada, there's a crucial planning step they must take on the day they arrive. It's about capital gains.
This is so important. They need to prepare a balance sheet of all their property and assets on the day they become a Canadian tax resident.
Think of your arrival day as a financial reset button.
That's a great way to put it. On that day, the current market value of your assets becomes your new cost basis in Canada's eyes.
Can you give us a quick example of that?
Sure. Let's say you bought a stock years ago for $45. When you arrive in Canada, it's valued at $55. You later sell it for $60.
So Canada only taxes the gain made while you were a resident.
Correct. Canada only applies capital gains tax to the $5 profit you realized after your arrival, not the entire $15 historical gain. This single step can save you thousands in future taxes.
Now we need to address the massive administrative elephant in the room that plagues U.S. persons living in Canada. Those U.S. reporting requirements for foreign assets.
This is the biggest penalty trap for cross-border movers who maintain a U.S. citizenship or a green card.
Because even if you live permanently in Canada, you're still a U.S. taxpayer.
You remain subject to U.S. tax on your worldwide income, and you face some very severe foreign asset reporting requirements.
What are the two forms that cause the most headaches?
The primary one is the FBAR, or FinCEN Form 114. This requires you to report any foreign financial account, including your Canadian RRSP or TFSA, if the total value of all your foreign accounts goes over $10,000 USD at any point during the year.
And the penalties are serious.
Astronomical. We're talking $10,000 per violation per year.
And what about Form 3520?
That's the other big one. The IRS views most non-U.S. savings plans, including the RRSP and often the TFSA, not as retirement accounts, but as foreign trusts.
A foreign trust.
Yes, which requires you to file Form 3520 annually. It's an incredibly complex form with equally punishing penalties if you ignore it. This administrative burden alone is often why some U.S. persons decide not to even keep a TFSA.
This leads perfectly to the other tax complication for U.S. citizens in Canada, the net investment income tax, or NIT.
Right. So if you're a U.S. person living in Canada, you need to understand that when you take distributions from your RRSP or RRIF later in life, that income could be subject to an additional 3.8% net investment income tax in the U.S.
And that tax doesn't apply to a U.S. 401k.
It generally does not apply to qualified distributions from a U.S. 401k or IRA. It's a significant complexity, and it can make the Canadian plan slightly less attractive for dual citizens or U.S. green card holders.
That is just a staggering amount of individualized information. I think the highly personalized nature of this planning has to be the ultimate synthesis here.
It absolutely is. I mean, everything depends on your specific residency status, which tax treaty provisions apply, and whether you plan to stay in your new country or eventually move back.
And we have to end by re-emphasizing the foreign tax credit, the FTC.
We have to. It's your last line of defense against double taxation.
Explain why.
If you collapse your U.S. 401k and you pay U.S. taxes and penalties on the way out, you must have enough Canadian tax liability in that same tax year to use the foreign tax credit fully.
So the FTC lets you claim a credit for U.S. taxes paid against your Canadian tax bill.
Exactly. But if you don't have enough Canadian tax to use up that credit, you will end up paying tax twice on the same income. It's a significant, costly risk. So you have to consult your cross-border advisor first.
So much to think about. To leave you all with a final thought on the differing timelines, remember that U.S. 401k required minimum distributions, or RMDs, currently start at age 73.
And Canadian RRSP or RRIF RMDs start 1 year earlier at age 72.
But the real question you need to mull over is how that 3.8% IIT combined with the administrative risk of the FBAR in Form 3520.
How that changes the actual value of tax-deferred Canadian growth versus tax-free U.S. growth for someone who remains a U.S. person. That tiny 3.8% is the elephant hiding in the corner of your spreadsheet.
We hope this deep dive provides you with the essential foundation to ask the right complicated questions of your advisors. We'll see you next time.